Which business entity is best for you? What is a business entity? A business entity is a commercial, corporate, and/or other institution that is formed and administered as per commercial law in order to engage in business activities, usually for the sale of a product or a service. Essentially, an entity is what allows a company the ability by law to conduct business. Business entities should be chosen with care, as they have consequences, but can also provide benefits, and they can even save you money if chosen well. Here's why not every business entity will do. Your business entity matters. It has to do with money in both the present and the future, and you want to keep more of yours, right? The IRS recognizes the following business entities: sole proprietorship, partnership, corporation, and S corporation. An LLC is not considered a separate entity by the IRS. Let's look at business entities and taxes. Sole proprietors are the same as their owners. The owner pays the taxes on the sole proprietorship's profits. In contrast, a partnership does not have to pay income tax. Instead, the business will pass through its profits or losses straight to the partners. Then the partners will include their respective share of the partnership's income or loss on their personal tax returns. Corporations have to pay state and federal taxes. They sometimes also pay local taxes. This will include paying income taxes on profits, the opposite of partnerships and sole proprietorships. A corporation can end up paying taxes twice, first when it makes a profit, and the second time when dividends go to the shareholders. Only the wages of any S corporation shareholder who is also an employee will be subject to employment tax. Any remaining income is payment to the owner or owners as a distribution. Distributions are taxed at a lower rate, if at all. An LLC is not a separate entity according to the IRS, so it isn't taxed. Instead, its members pay individual taxes. Members of an LLC pay an employment tax on the entire net income of the business. Now let's check out the differences in legal liability. With a sole proprietorship, there are no limits at all to personal liability. If the sole proprietorship did it, then so did its one owner. This includes all debts and obligations and any risks from actions of employees. In partnerships, the partners retain full shared liability. Therefore, partners are not only liable for their own actions, they are also liable for any business debts and decisions made by other partners. Plus, all of the partners' personal assets can be seized to satisfy a partnership's debt. Within a corporation, the shareholders' personal assets are protected. Shareholders can usually only be held accountable for their investment in the stock of a company. However, if an employee commits fraud or a felony under the corporation's direction, the corporate veil can be pierced and personal assets can be on the line. The obvious solution? Don't tell your employees to commit fraud or felonies. An S corporation shareholder's personal assets, like personal bank accounts, cannot be seized for the purpose of satisfying any business liabilities, like verdicts against the company. LLC members are protected from personal liability for the business decisions or actions of the LLC. If the LLC incurs debts or is sued, the members' personal assets are usually exempt, but not always, hence the term limited liability. What about costs and shares? In a sole proprietorship, the owner is the company. If it makes money, then so does the owner. Their share is 100%. When it comes to partnerships, the partner shares vary, and they should be clearly spelled out in the partnership agreement. If the shares are not specified, they are assumed to be equal. An LLC is another type of corporation, and the only real difference is liability rather than shares and costs. So it works like other corporations. A corporation is run by its board of directors. These people are usually also the owners. Ownership stakes are defined by what percentage of stock everyone owns. If one person has controlling interest, over 50% of the stock, then their decisions will generally overrule everyone else's. If the shareholders have smaller stakes in the corporation, sometimes shareholders will band together to influence decisions or even eject board members. Profits are generally distributed per share percentages, although board members can take a salary. In an S corporation, a shareholder working for the company must pay him or herself reasonable compensation. The shareholder has to get fair market value, or the IRS may reclassify any additional corporate earnings as wages. When is a sole proprietorship best? Sole proprietors do it all. This can be exhilarating, but also exhausting. Some people love this kind of independence. You are definitely your own boss. Solos make all the business decisions, but they can always ask for advice from experts and mentors. Risks are high for solos because if the company is sued, so are they. But the rewards are also high because they don't share the profits. When is a partnership best? Partners share the spoils and the responsibility. The sizes of their shares dictate how much say they have. Silent partners generally just want to throw in their money, take out their profits, and not much else. Partnerships carry a measure of risk. Partners are responsible for their own and the other partner's doings. It's imperative that partners be trustworthy and responsible. Plus, partners also need a plan in the event one of them dies. When is a corporation best? Corporations are lower risk, usually. Business profits go on the business's tax returns and not the owner's. Corporations are independent entities, so they can be held liable in court for negligence. The number of shares will dictate how much power an owner has. Owners with over 50% of the shares aren't always invincible. Smaller shareholders can band together and become a voting bloc and influence the company's direction better than if they acted alone. When is an S corporation best? An S corporation will carry lower risks, but business profits will be reported on the owner's personal tax returns. However, the owners can save on Social Security and Medicare taxes. S corporation owners are protected from personal liability for its business decisions or actions. S corporations are limited to only 100 shareholders. Those shareholders have to be individuals or certain trusts and estates. A foreign citizen cannot be a shareholder in an S corporation. The company has to operate domestically. The owners will pay taxes only on the money they earn from the business. This is recorded as personal income. The business itself is not taxed. Owners of S corporations who are also employees pay taxes based only on their compensation. This means they don't pay Social Security or Medicare twice, like owners of unincorporated businesses have to. When is an LLC best? A limited liability corporation carries lower risks, but business profits are reported on personal tax returns. This can result in owners paying high taxes. They also pay an employment tax on the net income of the business. An LLC isn't a separate entity per the IRS, yet LLC members are protected from personal liability for its business decisions or actions. If the LLC goes into debt or is sued, the members' personal assets are usually exempt. LLCs are often used by groups of professionals, like doctors' practices and law firms. Let's recap. Business entities make a difference in terms of taxes, liability, and costs and shares. Choosing the best business entity means considering what will happen if the company is sued, being comfortable with who is an owner and the ownership structure, and deciding how hands-on an owner wants to be. Contact us today to learn more about which business entity is best for you.